Welcome to Family Office World Media. I love doing this, and I particularly am going to like this episode today because who we're talking to and what we're talking about. Um, Zach, jump on the screen for a second, Zach. I think that what's fascinating is I put together a conference in November with McDermott and AQR on tax-aware investing, and we had about 80 billion-dollar families on the call. And one of the things they said during this conference, it was all on tax-aware investing, and AQR is growing at like $3 billion a month. It's insane. Um, but one of the things one of the attorneys said at the conference was that as many calls as they were getting about AQR and Quantino and companies like that doing tax loss harvesting, et cetera, they're starting to get these amount of calls on ETFs. So I did a little research, and I understand ETFs well, but certainly not as well as Zach. And I had him talk to one of the top estate planning attorneys at McDermott, and to explain it to him, so I knew so I could ask he could ask what I don't know. And we were on a call, and he's like, "This guy has created something that it's a better mousetrap. He's created something that's very, very innovative." So, Zach, I'm thrilled to have you on the show. Maybe just to start, if you could take a minute, a little bit about your background, and then it is fascinating because tax-aware investing, it's obviously so commonsensical for most people, but it's not top of mind for most family offices, but it obviously should be. So maybe a little bit about your background first.
Yeah, no, look, it's an honor to be here, Ron. It's funny. I always like to say taxes are the unseen cost in a person's investment return. But my background, so I've spent my whole career in institutional investing. But how I came into the investing world started and ended with family offices. I was a teenager that was interested in investing. It was just a cool concept, and the only people that would spend time with me were family offices. And so I went around and I shadowed them and I learned from them. And when you learn about investing through that lens, one thing is very, very clear: taxes matter. It's not about what you make; it's about what you get to keep. And I got very particular. One piece of advice was a superior knowledge of the tax code is one of the most competitive edges you can have as an investor. And I could say at the time, I don't know what that really meant, but I could say it's very core to the ethos of who I am. But roll forward, I've spent my whole career helping solve complicated problems and make investments in the institutional world. I started my career unwinding an investment bank that had gone bankrupt during the financial crisis. I went to go work doing portfolio management at Wellington, where I was first introduced to the concept of ETFs, and I'm sure we'll unpack that. Before I went to go lead investments for a large single family office, which ultimately led me down the path of creating Twin Oak.
Got it. So you're all in on ETFs. I guess we'll start with the macro. Why?
So this actually goes back to my time at Wellington. I've been managing institutional portfolios, didn't really understand, we never looked at tax lots. We never cared about the after-tax return because that wasn't, we were managing mutual funds or institutional accounts, and taxes were not part of the framework. And they were trying to grow in the family office channel, as many people were and continue to do. And again, you get back to that answer very quickly. After-tax returns matter. And when you start thinking about all the different ways in which you can drive, as we like to call it, like tax-aware outcomes, right? How do you trade? Where's the asset domiciled, whether it's like in a taxable account or a brokerage account, or, an IRA? You get to the structural question of how do you actually buy, what is the vehicle in which the investments are held? Is it onshore? Is it offshore? Is it in a partnership? Is it a unit investment trust? And there was just this very clear, simple answer. And I had a very aha moment. ETFs. They're simple. They're in your brokerage account. They're well understood. They've been around for, decades, and they can just be an incredible, powerful tool for tax deferred compounding.
So you got all in on this. Question: why, in your opinion, aren't more people familiar with this? Because I mean, ETF itself is not. It's not complicated. the concept, but why aren't more people understanding this?
Yeah, people ask me this all the time. What inning are we in ETF adoption, right? ETFs have about $14 trillion invested in them. So like by no means are ETF unknown. But I don't think a day goes by where I meet someone and I'm talking about ETFs all day, that they're like, oh, I didn't realize ETFs were tax efficient. They were easy to buy. And so I think there's just a missing piece of education of why are ETFs tax efficient and how are they different than a mutual fund? How are they different of an SMA? Despite $14 trillion in there, it's still really very misunderstood.
So you're looking at ETFs it's just structural alpha, right?
Exactly, right? If you have a mutual fund versus an ETF, BlackRock has done this study a number of years in a row now. A comparable strategy in an ETF versus the mutual fund wrapper generates 2 points of tax alpha in the ETF versus the mutual fund.
Now you told me, I remember, it makes sense intuitively, and once people understand it, it's objectively a superior model to what exists now. But when you were at Wellington and you tried to create this, talk about how you had like resistance and like you had a better mousetrap, and yet you went to BlackRock and different firms and they didn't want to do it. And what caused you to start Twin Oak?
Yeah. So my love affair with ETFs goes back 10 plus years now. And the starting point is I think there's a lot of institutional inertia. This is not unique to financial services, but maybe it's most acute here. There's what they call the innovator's dilemma, right? Yes, ETFs are the vehicle of the future, but it might cannibalize what I'm doing today to transition from there. And as much as mutual funds are dying, and that's been very well documented and well known, still incredibly profitable to run a mutual fund business. And so it's this chicken or the egg problem, and everyone just kicks the can down the road. I think that's the starting point why there's been resistance. What triggered for me was when you're sitting here and you're getting all these pitches to make allocations to someone's hedge fund, to someone's private credit fund, to a long only equity manager. I kept having this realization on an after fee, after tax basis, nothing is worth doing. I should just go buy an ETF, set it and forget it. And that power of compounding is really powerful, as you know, and so many people know. If you had just bought the S&P 500 in an ETF wrapper 30 years ago, and you removed the frictions, right, the rebalancing frictions, and you just kind of set it and let it compound, you would have more than 30x your money. How many investors do we know that 30x their money over any period of time? And that's just if you just bought the S&P, set it and forget it. And so I kept coming back to if I could put other strategies in there, or if we could do something more dynamic or more advanced, you had this huge home run, right? Millennium as a hedge fund is one of the greatest returning funds that have ever existed, right? It's done 12, 13% returns consistently year in, year out. And I would venture to say on an after fee, after tax basis, it would not be worth it for a taxable investor to invest in Millennium. But what if something like Millennium could be offered inside of an ETF and made more tax aware? That would be really powerful.
So when you I know you went to BlackRock and a few other companies and told them about this concept, what was the response, and why would they not do this initially?
Yeah, I think there was a couple. So there's the innovator's dilemma issue, right? I don't want to cannibalize my existing business. And it's the same when I went to hedge funds and said, hey, you guys should ETF your strategy. Well, I'm not going to cannibalize, 2 and 20, even if it is a better product. So that's one. And I'd say the other was too complicated, right? The ETF industry as a whole, if we go back to the starting, was based on, low cost, low trading, passive funds, just buy, set, forget portfolios. And what we're talking about here is doing more active management, right? Trading intraday, trading more exotic instruments, and doing so through kind of a system that was built to handle long only, vanilla equities. And so there's a lot of kind of institutional operational roadblocks that you get to. And for firms like BlackRock, Vanguard, State Street, right? They need a fund to be $50, $100 billion to really move a needle in their portfolio. But you can make a great investment firm and a great investment product on $100 million, on $500 million. And so we really wanted to serve that market where we could build advanced tools, focus on smaller funds, more advanced funds. If we get to a $50 billion fund and the pipes start to break in the system, like that's a good problem that we can kind of address as we get close to those problems. But that to me wasn't a reason to not start.
But you get pushback from all these firms initially, right?
Yeah, no, they all said no. Some of it was also, too small, right? Oh, that's cute. You want to launch $1 billion fund? Not interested. That was another big pushback. They're built to launch products that can scale, low touch, both low touch from the client standpoint and also low touch from the operational standpoint, where we wanted to do more active client management and more active strategies.
Okay, so let's say I have a family office. Let's say my family office is worth $10 billion, and you come to me and say, hey, you start talking about ETFs and what it can do. What, from a macro standpoint, how do you position that?
Yeah, the starting point is I say, like, let's just make sure we clear the air of like, what is an ETF and why is it tax efficient, right? So an ETF, when it goes to sell a security, so sell Apple, buy Microsoft in the simplest example, it doesn't actually sell Apple and buy Microsoft, which is a taxable event. It does this thing called a custom in-kind basket, a custom rebalance, right? And it effectively swaps Apple for Microsoft, and that does not create a taxable event for the fund. And that's the power of the ETF, right? It gives you the ability for the basket on the inside to kind of reposition and remove over time, but it doesn't create taxable events when it's managed that way for the ETF shareholder. You have to consciously manage it in this way, but it gives this really powerful tax deferral capability. And the starting point is just getting people to understand that, right? I've met people that have $1 billion ETF portfolio that did not know that their ETFs were rebalanced internally.
They did not know that.
They did not know. They're just like, oh, I could buy it. It was easy. It was simple. I could buy it at myfidelity.com and I didn't have to pay a ticket charge.
Okay, so let's look out 5 years from now, because like when Quintino started and AQR and all parametric, people when something works and something's effective, it goes in scale, and particularly this, because this is tax that we're investing. What's this going to look like in 5? Because we're still in the infancy. What's this going to look like in 5 years?
Oh, I think you're going to have a lot more ETFs that are really tailored to family office needs. We hope to be a purveyor of many of those because family offices needs are different than, a pensions needs, which are different than an endowments needs. And so really creating solutions that come from those family offices, right? Your family office wants a strategy that does, I'll just make up an example, a tail risk hedged S&P 500, right? You want S&P returns, but you really want to reduce your risk of loss. So that might be something and managed in a really tax efficient way that works for you. And you're going to see more of those kind of customizations and flavors come out that are things that you want to invest in as a family office. And the beauty is once we create it for Ron, for your family, other family offices can go buy the same strategy. They don't have to create it new every time, right? And so we're designing these strategies and we're building out kind of this library of strategies that families are asking for, which is, I think, you're going to see a proliferation of that because families, I'm sure the audience here sees this all the time. They're kind of this like weird client type, right? Sometimes they're covered through like a retail kind of wealth management channel, but sometimes they're also bigger than the average institutional client at a firm. And so they fall through the cracks through that. And so they don't necessarily get solutions that are tailored to them, and they don't necessarily get the high touch service that they should get. And so these custom ETFs, these family office ETFs are a way for them to kind of have their cake and eat it too.
Okay, so low hanging fruit. So you go to a family office, who's kind of like a slam dunk, like this is the situation. ETF, it's not even 100% you should do this. What would that look like?
Yeah, I think there's two components. There's like, what does the portfolio look like today and what do they want it to be? So someone who values liquidity is very important because like this sits in your brokerage account. You can sell it every day. You can margin it. It's readily available. That's one. Someone who is looking for kind of some dynamicy in their portfolio, right? So maybe wants to do some reweighting between US equities and international equities, between equities and fixed income, all within a single vehicle. Because if you're just sitting there with cash today and all you want is the S&P 500, you should go buy the cheapest Vanguard fund you can find. So I think so that's on the portfolio side. And then what does their portfolio look like today? People who have been doing tax loss harvesting and have ossified portfolios. Because the piece that we didn't talk about yet is, there's this unique ability, similar to the 1031 exchange in real estate where you sell a property and roll into a new property. ETFs have the ability to do what's called a 351 exchange, where you can take an appreciated portfolio and use that to seed an ETF, and that can be done on a tax-free basis. And there's certain rules that governs it, but as long as you're within those rules, you can roll your existing portfolio into the new ETF. And so if you had a S&P 500 tax loss harvesting account that is ossified and you have tracking error, you're not buying that portfolio is locked, so you're not going to get to buy into SpaceX when it IPOs or Anthropic when it IPOs. If that could be flipped over into an ETF, you could still get that same S&P 500 tracking now. You didn't create a taxable event on the way in. And as new companies are added to the index and new companies are added to the market, the portfolio can rebalance to include those. And so it's a really great way to remove tracking error, to remove those frictions that add to portfolios as they become kind of.
So why would I know AQR's raised a ton of money doing tax loss harvesting. What's the pro and con of doing an ETF versus that strategy?
Yeah, I mean, I think the starting point is the liquidity of this, right? It's a single line item. It sits in your brokerage account. There's not 1,000 line items on your 1099 of buys, sells. It's not a private fund. And then the other thing I'd say is it's customizable, right? If you want to go to AQR, Quantino, et cetera, who I think are great firms, right? You can get their A, B, or C flavor, right? You can have a 120 or a 150, 50 long short. You can have a 250, 150 long short, or you can add managed futures overlay, right? And those are your options. Here we're saying we think we can fit a lot of strategies inside of an ETF. What are the strategies that you're invested in today, or that you would invest in if it was more accessible? And then we go and build that for you.
So what you're it's just structural out. There's no difference between this and AQR and PPLI as far as what you're trying. It's just structural alpha, correct?
Yeah, it's a great way to how I like to think about it is if you can know the outcome ahead of time, it's structural alpha. I know that an ETF relative to a mutual fund creates 2 points of alpha per year as a starting.
And say that again.
An ETF relative to a mutual fund, right? Historically, it creates 2 points of alpha per year, and you know that going into the trade. Same thing with a tax loss harvesting account. Going into that there will be tax alpha and it's definable. PPLI, same thing. And so an ETF is just a continuation of that in a different vehicle that I actually argue is much more accessible than all of those, right?
So then then why shouldn't, in theory, everything be an ETF in your world?
I actually think everything should be an ETF. That is kind of the mission and vision of Twin Oak. And that's why we're, on one side, we're working with family offices, multifamily offices and their advisors to hear what they want. Tell us the strategies you want in ETF form. And then on the other side, we're working with hedge funds and legacy asset managers on ETFing their strategies, because we think there's a void of those types of capabilities that have been developed over 20, 30, 40, 50 years in kind of active markets, to bring those tools into an ETF, but help them fit inside kind of the tax aware framework. I agree with you. I think everything should be an ETF, and that is our mission.
Can you walk me through, just maybe without names obviously of the firm, but just 2 examples of people you're doing it for? Just walk me through what they were looking for, why it made sense, and what you're doing with them.
Yeah, I mean, we usually start with clients with what is their problem statement, what is their pain point that they're trying to address. I think I mentioned the tail risk hedged S&P 500 fund as an example. The client's total portfolio, broader than what Twin Oak sees. They're our portfolio has a huge volatility. It has a 70% annualized volatility because they invest in a lot of high, small cap stocks, early stage private companies. So they're just, they win a lot, they lose a lot, and in aggregate it has done very well, but creates anxiety along the way. 70% volatility feels good one direction, doesn't feel great the other direction. And so we kind of came back to them with a solution for how do you address that, right? If you had a part of your portfolio that could serve as that ballast, a tail hedge, that would help offset your volatility. It would help reduce your pain and drawdowns. And so when you put that together with their equity portfolio, it actually looks really great. And so that was kind of an example. We created that fund in partnership with them, knowing that that's kind of was really additive to their overall allocation. And by putting those two pieces together in an ETF, you created something really unique. Because when there's a drawdown in the market, one of the problems with private funds that do tail hedging, and there's some really famous tail hedge funds that do that, is rebalancing away from the hedge in that painful moment into the equity is taxable. It's taxable, and it creates a quote fee drag because you're paying carry to the manager that you're pulling from, and then you're trying to redeploy the balance back into the equity markets. We created that in a package in an ETF form. Does it all frictionlessly.
So what percentage of the families that you're going to, and you're talking about this ETF strategy, what percent would you guess kind of, yeah, I've heard of this before, or I get this, and versus I kind of thought I knew what it was, but I don't.
I think it's mostly the latter. Like I think most people don't really, they haven't heard of this, or they heard about it a little bit. There's been some articles here and there, but I think it's still pretty novel. We hear a lot. I don't want to be the first, but I don't want to be the last. And so it's an important problem, but it's not always an urgent problem. But what I tell people is it's an important problem, but it's not an urgent problem. But when it becomes urgent, it still takes time to create these. So you should start proactively exploring this, getting up the curve, thinking about if you did do it, how would you do it, and who would you want to partner with? Because when that moment comes where you have this realization, oh my God, I wish I had been in an ETF for this, you should have done it 6 months earlier.
Okay, what's the downside? Let's flip this. Why not do an ETF?
Yeah. I think there's this concept of lack of control that people are losing, right? Like if you have just a simple example, you have 100 stocks that sit in your portfolio that you're doing this yourself. And now you're kind of transferring that out into somebody else's hands. You don't have kind of the touch and feel of the portfolio in the same way you did before. ETFs are daily transparent. You can see all the trades we make. You can see all the holdings we have. It still sits in your brokerage account. You can still sell it with no notice whatsoever. But I think there's a little lack of control issue that comes up. And I think there's a lot. It still feels really novel. Like again,
those are the two main reasons why not to do the ETFs.
Yeah, this is what I hear from families is this seems super novel. I need to learn more, and I still need to digest because I think once you see it, right? Once you see the power of removing the friction of rebalancing and the liquidity aspects of an ETF and the diversification of an ETF and the simplicity, it's almost like, why did I do any of these other things? And if that's so good to be true, maybe I'm missing something.
So do you get a lot of, okay, sounds too good to be true, we'll talk later?
Yeah. My favorite was the first person I ever went to with this idea. It was a family office in Boston. And this sounds really cool. If this was true, Goldman would come to me and pitch me this idea. And I tell you, 2 years later, I got introduced to it was a friend of mine. I got introduced to this person from his advisor at Goldman. He's like, you should talk to Zach about this. And he's like, I guess you were right. Goldman did eventually tell me about it. And so it's to me, it's a matter of, when, not if, that people will get there.
And then how long does it take people to get their arms around this? I know with PPLI, it's a phenomenal product, but there's a lot of brain damage that goes into this. How is that with ETFs?
Yeah, so I think PPLI is, as you know, it's insurance. People have to get underwritten. There's legal. You want to understand the legal framework that it operates in. ETFs. The nice thing is that most people actually still own ETFs, right? Even if they don't understand it, they've somehow bought one in their career. So it feels much less novel than private placement life insurance. And this is also why we try and work with really great law firms, because that helps cut down that time to understanding it. Because the nice the ETFs, like it's a well-defined, the framework has been around since the 1940s. And so ETFs have been around for 35 years.
Right.
It's a pretty well understood structure. We're innovating in kind of what can be in the structure, and we're innovating with how to access that structure and what strategies go there. But it is a well understood legal framework. 351s is the example, which is the seeding mechanism we talked about. Trillions of dollars go into 351s every year because it's just a corporate tax restructuring code, right? Like you're restructuring corporations. And so both of those components are actually really, really well understood. And we want to work with like top tier law firms on that, because often these families have those relationships already, right? Like if you're already a client at McDermott, or you're already a client at Skadden, et cetera, like that cuts down the learning curve pretty meaningfully, because you already have a trusted advisor that understands these.
So when I first heard about this, I mean, I remember the first thing, because I was looking to do this for myself, and the first thing I did is I introduced you to one of the top estate planning, Patrick McCurry, who's one of the top income tax planning attorneys at McDermott. And I just said, Patrick, just poke holes in this. Tell me what's wrong with it. And I remember on the call, he's asking a lot of questions, trying to poke holes, because I asked him to poke holes in this. And then he's like, I understand 90% of this, but there's certain things I don't understand. And then he set up a second call. And the second call was with, I think there were 8 top senior partners at McDermott on the call. I was listening and you were defending. And they were almost trying to poke holes in it. And I guess my question is, at the end of the call, the response was, this works, this makes sense. But during the call, there were a lot of top estate planning attorneys, and McDermott's arguably one of, if not the top, law firm in the world. A lot of these estate planning attorneys didn't understand this. Why? Well, why?
I mean, again, you're like combining a lot of different disciplines into this kind of package, right? Like it can be very powerful as an estate planning tool, but it's fundamentally, like a financial products tax code question, right? So they're adjacent, right? And they can be used really powerfully together, but it's not necessarily their day-to-day expertise. And so I think there's also, again, to the same thing that first family office I talked to about was, it seems almost too good to be true. And I get back to like, I'm a buyer of ETFs, as you can tell, created a company dedicated to do this. The mutual fund industry is like 10 times or 5 times the size of the ETF industry, right? And so as amazing as ETFs are, they're still the little cousin compared to the rest of the financial industry. And I think that just takes time to overcome. And the ETF industry was very much like thought of, and I still think to some extent thought of as this like retail backwater, right? Like that's what DIY investors at their go to buy at their home. But you're seeing endowments buy them now. You're seeing pensions buy them. You're seeing elite family offices build their own. And it just takes time to kind of flow through the channel and get people up the curve.
So I'm getting a bunch of questions from the audience. One of the questions that I just got is, can people that aren't family offices, which is 99.99% of the world, benefit from this?
Yeah. What I always like to say is like, we're fundamentally democratizing access to the things that the family offices want, right? We build this tail hedged S&P 500 type fund for a family, right? It like solves their pain point and it solves their need. But what worked for Ron's family also works for, Joe on the street, right? They now get access to those same types of strategies because an ETF is fundamentally, available to be purchased in a brokerage account. So, it might cost,
I get it,
$50 million to build the first one, but the second one can be bought for, $25 a share.
Get a whole bunch more questions. I'll put them up on the screen and then let you answer it, because we're getting a lot of questions from the audience right now. First question is, hi Zach, Ron, how do you approach small caps for this strategy?
Yeah, I mean, so small caps can, like anything that's an equity or a security can go into an ETF. What you need to be wary about with small caps is, capacity constraints, right? Like if, an ETF, as amazing of a vehicle as it is, it has a problem. It can't be closed, right? You can't like shut off new buyers of the fund. And so sometimes we might say a small cap strategy, like, that doesn't belong into an ETF. We'd have to unpack the underlying components, but that might not be something that does fit in an ETF. And like, that's where we kind of use our institutional experience to really bring those knowledge and insights into the building process. Like I've managed small cap portfolios. My partner Greg, managed portfolios. He worked for Michael Burry, trading in some of the micro cap securities. And so like we have a really deep domain.
Michael Burry, he's the big short guy.
Exactly.
Interesting. All right, I got a couple more questions. I'll put them up on the screen for you to answer because we're getting a lot. Zach, what are the tax implications for selling put options with a low floor? The position is in cash and no shares get put into the investor week over week.
So I think the idea of kind of like selling, I'll just say like S&P puts versus cash. So, the selling of an option generates income, right? Whether that's in your portfolio or an ETF. And so these are ones of those things that I'd say like the ETF as a wrapper doesn't necessarily make it more inherently tax efficient. It has to fit inside the structure. And so short options in that form are not a great fit because it creates income. And you see that there are funds out there that do sell a lot of calls, sell a lot of puts, and they generate a huge tax bill for clients, even though they're in an ETF wrapper. But with that said, you can structure those things to kind of fit inside of an ETF and be more tax aware. And it's about who do you partner with and how is the fund designed. And so you need to pay attention to that when you look at ETFs.
Got it. Okay, got another question that I want to put up on the screen because again, I think that we're getting a lot of input, a lot of questions. This one is from Stephen Shape. What do you think of covered call ETFs? The pros and cons, tax implications, and does one outweigh the other for your recommended portfolios?
Yeah. So, I mean, look, you've seen a huge proliferation of covered call funds. Like the biggest one is a fund called JEPI, which is JP Morgan's covered call fund. From a tax perspective, it's not great, right? It distributes out income that you as the holder have to pay tax on. So if you're going to buy it, you should buy it in a tax favored account. I also think from like an investment standpoint, it creates a problem, right? JEPI is kind of to that same concept as a small cap fund. It's a victim of its own success. It's a forced seller of a certain strike of calls every single month, and it has to roll those every single month. And so what that creates is it creates a buying opportunity. If you're willing to go long a call, you're buying a call cheaper than you should be kind of just theoretically because JEPI and others are forced sellers. And so we like to position this is back to the active management side. We like to take advantage of those, right? When you can buy something that someone is a forced seller. Throughout my whole career, that has been a phenomenal way to make money and make alpha for clients. And so we try and take the advantage of the other side. And by going long calls as opposed to being short calls, you can make them kind of more tax efficient. And so there's a lot of ways in which you can kind of play that to help clients.
I remember, when AQR was presenting, I heard so many different reasons, what the pros and cons of doing that, et cetera. Why would somebody who has a family office, or even somebody who doesn't have a family office, what are the what can go wrong in this? Like more than most people on this. What are what can go wrong?
Yeah, I mean, I think the starting point is the rules of kind of what you can contribute into an ETF and a 351 exchange are very clear. So like what can go wrong is you somehow find a way to trip one of those rules, right? And the big rule is diversification. So a portfolio has to be considered diversified by the IRS to contribute it in. And that means no one position over 25% and the top 5 positions not over 50%. Like that's the easiest way to blow this, right? Like you can't contribute 100% of a fund as NVIDIA. That wouldn't work. And this is why it gets back to like we love working with like really sophisticated tax counsel. That doesn't scare us. That actually excites us when clients have really sophisticated advisors around them, because we want to think through all these edges. Things will come up that no one's ever thought of potentially, and it's great to have really smart partners around there guiding you. So that to us is, probably the biggest thing that you could go wrong is what's called like a bad 351. We will check all of the work that the outside counsel is doing. We have tax counsel on retainer that helps us navigate all of that. But those are the biggest things, is finding a way that you messed up something in the process, which is why it's important to work with, people who have done this before.
And outside of that, is there anything that like unexpectedly unintended consequences that can go wrong?
Yeah, I mean, we're investment first is how we always like to say it. Is like, do you like the strategy that you're buying, right? Like you're buying into this strategy. Are you happy with that? To the prior question that got asked, right? Like if we told you this was going to be, managed in a way to not create income and managed in a way to not generate distributions, but then all of a sudden we're selling a bunch of covered calls and that generates a ton of income for you, you know, you're out of luck. And so it's really about understanding what is the investment strategy that you're going into, and would you be happy with that? Because the power of an ETF and the power of all of this is tax deferred compounding. And so the longer you can stay in the strategy and the longer you can allow your capital to compound tax deferred, the more powerful it is. But if you don't like the strategy or it's a fundamentally flawed strategy, you have a problem.
So I'm sure it's going to be different, but what ETFs in general are families looking at? Is there something in general that families are looking at?
I mean, the biggest thing we always hear, and like this shouldn't surprise anyone, is the markets have had a phenomenal 15+ year run. Balance sheets are very strong, and so people are much more worried about the next down 20 move than they are the next up 20 move. And so they're really worried about kind of taking down risk in their portfolio. But with that said, a lot of them are fortunate enough to have enough liquidity to not necessarily be worried fully about a 10% drawdown or a 20% drawdown. And so they still want to maintain equity exposure. And so that's kind of, I keep coming back to this hedged equity product. But like that is what we hear a lot from families. They're really worried about waking up one day and a down 20% move because something happened geopolitically or a massive inflation shock. That's kind of what we hear the most. And then the other thing that we hear the most, which we're still working on a solution for, but is like people are way over indexed to privates. Private equity and private venture capital and private credit, people have been spending a lot of time building up allocations to for the last 15 years, often at the expense of public markets or their public market allocation. And so, how do they rebalance their portfolio away from privates and towards more liquid strategies?
I'm wondering because you read and hear about AI every single day. Is AI going to have any impact on this?
I mean, obviously, like more stocks that we invest in will be impacted by AI, just as kind of the world will be. For us, we're leaning into it pretty heavily. The nice thing about starting an investment firm in the modern era is that we can really think about how is it architected. As opposed to every time having to scale with like people and infrastructure, we can scale with servers and use AI to make ourselves much more efficient. And we like to use that as a way to pass through that savings to families and our clients. We've taken the Costco model to building, right? Like we want to make a fair amount on all of our products, but we really want to pass these economies of scale through to our clients because we believe these are long-term partnerships, and that's the right way to build. And so AI allows us to do that. When we first started Twin Oak, the idea of like competing against Vanguard and Fidelity and BlackRock was terrifying, right? Like they manage tens of trillions of dollars. Their budgets are huge. Their cost structures are already scaled. How can we possibly do that? Technology and AI has allowed us this a massive amount of capability to the point where like maybe I'll never get my price structure down to Vanguard, but like I think we can be reasonably competitive with really scaled players because of this.
So I'm curious. I've been in the family office space for 25 years. You're a little bit newer to it. You've been in it for a while. What have you learned about working with family offices? Or what surprises you?
This doesn't surprise me. This is a plus, not a minus to me, but like it's very trust and relationship driven. You're harvesting a forest over a lifetime. You're not, looking to clear cut it tomorrow. So it takes time. You build relationships, you build trust, you provide value, and you get to know them. One of the things I love the most is, obviously we want to work with them on their portfolio that we can address, but I love when they come to us with other problems. Like I like helping them beyond kind of the scope of kind of our day-to-day relationship. Because that, you're becoming an advisor, you're becoming a trusted counterpart. So it's it always surprises me pleasantly when we get to that point with a client where they call us about something entirely unrelated to anything we've ever talked to them about. It means we're kind of doing what we said we were going to do, or we're trying to add value to them as clients and as people.
Can you double click on, you talked earlier that some people wouldn't want to cannibalize some of their own portfolio, their own 220. Can you talk a little bit about, because that comes back to conflict of interest, which is one of the issues with Wall Street. So touch on that for a minute.
Yeah, right. So obviously, a 2 and 20 private fund is a great business, right? You get paid 2% of the management fee, you bill all your costs to the fund, and you get 20% of the profits. It's a great business. The business is also kind of stagnated. Hedge funds are not generally growing as an allocation, and they're definitely not growing in family office world because of their tax drag. And so what we like to do is we go to them and kind of where 1 + 1 is greater than 2. We're not trying to just take their hedge fund strategy and put it into an ETF and be a 1-for-1 carbon clone, because that will cannibalize their business. We're trying to say, okay, what is the things that we're hearing from families that they want? And on the other side, what are the capabilities that you have that we could blend together? So could we do a 90% equity portfolio with a 10% hedge fund overlay, right? This concept of portable alpha, where we could reduce the risk to a client and really enhance the risk return attributes of the fund. And that's a great distribution mechanism for a hedge fund, and it's a great distribution access vehicle for a family. And so that's where we're trying to help people navigate those intricacies.
I remember when we were talking a little bit, I think it was yesterday before this, and we were talking, and you were really excited about something, and I'm like, what's going on? And you said you just received, there was like a 40,000-page textbook on financial products, laws and regulations and stuff, which leads me to ask the question, so you were super psyched about that, right? Did you have friends as a kid?
You've asked me a couple times what I like to do for fun, and outside of Michigan sports, which I have to say, just to rub it in, go blue this week. I love getting deep into the weeds of what we're working on. Right? It just keeps me going. It's I love pulling back at the layers of the onion to unpack it. This is just that for me. It's one thing to say, I'm not a tax attorney, and I should make that clear for all the people listening. But having that superior knowledge of the tax code is a competitive edge for us. And actually going back to the source code, the source documents where this all comes from, AI is amazing as doing research. But if I can get back to the actual document that it's pulling from, you can actually read the ins and outs without the summaries. And that critical judgment is important, I think, in building something that's new and novel.
Got it. So I could see obviously how passionate you are about this, but back to my initial question. I mean, did you have friends as a kid?
Ron, I grew up, in the same hometown as you, a different
And
era.
I didn't know you.
Different era, but had a lot of friends, still do. But what I love doing is creative problem solving was beaten into me as a kid at school in Highland Park, and that is my passion, is creative problem solving still.
Got it. So one question that I ask every guest is, and it's not so much about what you do on a day-to-day basis, but I'm a huge believer in just gratitude. Because I think being grateful is such an important part of life. What are you most grateful for? And the answer can't have the letters E, T, or F.
Sure. I have a lot of things.
It can't have tax-aware investing.
I have a lot of things I'm very grateful for. Start point, my wife, who is an attorney, not a tax attorney. Her support in building all of this has been unbelievable to me. But it's really the people, right? The people that have mentored me along the way, yourself included. I learned from the people that created the family office framework, the tax framework, the legal framework, the investment framework, and that teaches me. It paved the road for me. And what I think is unique, and I like to impart to young people when I talk to them, is you don't have to meet all of these people to be mentored by them, right? A lot of these people have written books where their knowledge is on the page, and I can feel like I've been mentored by people that I've never met before. Podcasts, right? Podcasts like yours. David Rubenstein is an amazing leader in the family office space and the private equity space. I've never met him, but I feel like I've learned so much from listening to all of his interviews. And so there's a lot of those people out there, and you don't have to meet them all to learn from them. But when you do, and you meet some of the really great ones that share their wisdom, share their network, and share their friendship as you navigate this, like I could not possibly be more grateful for those people. I go back to like the first one I was 12 years old when I sat down with my first family office, and they were the first people to tell me what investing was. And that person, I'm still a
Hold on.
friend.
You're 12 years old and you're talking to a family office, which is going to dovetail right back into my question. I mean, seriously. So, what did you do socially? I mean, I get the passion.
I mean, it's fun. A lot of my friends are those people, right? Like my friend, friends are these, 60 and 70-year-old principals of families,
I
people
don't
who run
judge.
family offices. And I just enjoy learning from them, and I enjoy debating philosophy with them, hearing their stories. I was 12 and I was interested in investing. And the only people that would spend time with me were family offices. The hedge funds the hedge funds and the banks were like, "Hey, you're 12 years old, like get the hell out of here." And family offices saw something in me, or were willing to give me the time, and they became my friends.
Well, one of the things, I'm asked all the time, and this is a great question. How did you get your foot in the door? Because again, the question I'm asked more than any other question is, I've got a syndicate of 130 families between 250 million to 30 billion, et cetera. How do you get into that? How did you get your foot in the door?
Yeah. Just asking, honestly, asking, being humble about asking, not expecting anything in return. But that's what it's about. I teach a class at MIT on networking and the power of building networks. And I think people are often really afraid to ask, and the idea of networking feels really transactional. But my presumption when I meet people is that they want to help until I'm proven otherwise. And so, like, I'm always about kind of putting 1+1 greater than 2 into the community. And so, at the time, I was more of a taker earlier in my career as I tried to build that network, but I also tried to give back, even if it was a little thing. You meet someone, they're interested in a nonprofit, making a donation in their name to that nonprofit. They say something on a call like, "Oh, I'm interested in this topic in AI," and you happen to be reading an article. Taking that article and sending it to them with your thoughts. Like, there's little ways in which you can add a lot of value and build relationships. And as I said, like, they're built over a lifetime. They're not built overnight. And so, just starting small and not being afraid to ask for 15 minutes of someone's time. The worst they can do is say no.
And I mean, you do that as a 12-year-old kid, and I mean, that's the word chutzpah. That's kind of a bit of chutzpah to do
I
that.
didn't know better, right? I was just a 12-year-old, and at the end of the first meeting, all I said was, "Hey, anyone else I can meet?"
Okay, I got one more question, and then we need to finish up. I mean, I got a whole bunch more questions, but I can only have time for one, and then we're gonna have to wrap this up. From the opening comments, how did you gain a superior knowledge of the tax code? Was it mostly on the job learning? Did you take a course? Top 3 books?
Yes, all of the above. So I was fortunate. I took courses at MIT when I was in grad school, at Harvard Law School on tax. Like, I think that's a good way to understand technical structures.
Hold on. Did you go to Harvard Law School?
Did not, but I was allowed to audit some courses.
You okay?
Again, what do I do in my free time as a social worker?
I'm asking.
Um, you learn on the job, right? Like, you learn, the investment industry often is an apprenticeship industry. So you learn from people that came before you as they pass their knowledge, and you shadow them and help support them in the transactions that they do. But you can also study a lot of, like, how people used it, right? Like, you can look at the Rockefeller family and how they used trust structures around Standard Oil. You can look at the Pritzker family and how they used the tax code to create Marmon Group and others. Warren Buffett talked about that actually at the annual meeting last year. So there's a lot of ways to study the history, and you can hear about how different people used it. And there's people that use that today when they're making private equity investments. They're making investments to public companies that have net operating losses. And so it's really just about paying attention to what people have done. And then when you start assembling those pieces, you'll start organizing your framework for how you can use them when you see a problem that you've not seen before.
Okay, so last question: how, if people want to get in touch with you, what's the easiest or best way for them to get in touch with you?
Yeah, you can go to our website, twinoak.com. Our emails are on there. You're always welcome to reach out, whether it's about your family office that you're working on, or if you're interested in just talking about the family office space and potential careers. Like, we're always happy to engage with people and learn about your situation and what we can do to help, and who in our network might be helpful to you based on kind of what you're looking to do.
Got it. Well, this has been terrific. Were you social? I'm sorry. I'm just gonna. I mean, were you socially awkward as a kid?
You'd have to ask my parents, I guess. But Ron, we're friends now, so what does that say about you?
Not a lot. All right. Well, listen, this has been terrific. Thank you for this. And again, I think what you're doing right now, in 5 years, there's gonna be a lot more people. So, congrats on starting this, and great having you on the podcast.
Thank you so much for having me, Ron.